Well, hello everyone. This is Paul Damon, President of Family Capital Management. We are here to do our quarterly update and review. Now that 2017 is behind us, this information that we're going to share today will be pretty much through the end of 2017. So let's dive right in and get started. The first chart that you see on your screen is the S&P 500 index, and this goes back to 1997, and it shows the market cycles and the volatility. Since 1997, the market has had two significant run-ups and then two significant declines, and then finally a more significant run-up since 2009. About March of 2009, the market bottomed out, and since then it's been on a pretty strong run-up with a couple years with some declines in 2015 and 16, and 2011 were a couple times that the market had a 10 or 15 or in one case 20% pullback. But since 2009 we've had a really strong market run. The next chart shows the various valuation metrics for the S&P 500 in the top right-hand box, while the main chart shows the forward price earnings over a 25-year history. So price earnings is a measure of the market that's often used, commonly used to identify if the market is either expensive or below normal valuations. So the purpose of the slide is to evaluate whether or not the equity markets appear overvalued, and if so, by how much, or undervalued, and if so, by how much. And it's measured in standard deviations from the 25-year average. So if you look at the far right-hand side, you see current is 18.2 times. That means the average stock is paying about 18 times each dollar of earnings that it generates, for a PE ratio of 18. The long-term trend line is around 16, so that indicates that you can see that we're a little bit above the average, not significantly. Interestingly enough, in the most recent pullback a couple weeks ago, that PE ratio dropped pretty substantially because the market dropped about 10% in a week, and so the PE ratio came back to that 16 range, which kind of brought some opportunities, and but the market rebounded very quickly, as you probably know, and so it was kind of a short-term or short-lived opportunity. This next chart shows corporate profits. The left chart shows operating earnings for the S&P 500, as well as the consensus analyst expectations for earnings through the next 4 quarters. It is becoming clear that the pullback in earnings was due to what we call transitory factors, as earnings have begun to rebound as these headwinds subside. The charts on the right show how two facts that have historically been headwinds to earnings, which is the strength of the US dollar and weaknesses in energy sector earnings from low oil prices. Headwinds from a strong dollar have dissipated this year. The dollar has weakened, and it would appear that the majority of write-downs in the energy sector are behind us. So energy earnings are on an uptrend. The dollar has weakened, which does tend to help the economy because it makes our goods and services more affordable overseas. So it allows for more exports, and it makes imports more expensive, which tends to boost our economy, at least in the short term. The chart on the left here shows corporations have amassed a huge amount of cash and cash reserves relative to current assets. So the chart in the top right shows that corporate debt relative to GDP is increasing. But the bottom right-hand chart shows that this is not a huge concern given that interest coverage ratios remain healthy. So because interest rates have been so low, even though debt has increased, the cost of debt is significantly less than it was 5, 10, 15 years ago. And so therefore, yeah, the ability to borrow money is there, and the cost to borrow money is less and less. As a note, the amount of corporate debt is somewhat of a concern, and so we do want to keep an eye on it. It's approaching levels that we haven't seen since 2009, and before that in 2000. So, kind of in the backdrop of all this, we want to keep an eye on corporate debt. We believe corporations have borrowed so much because it is so cheap, so they're preparing for higher interest rates, and they're borrowing money now at these lower rates and locking in the cost of borrowing. On slide number 8 here, the left chart shows the relationship between earnings and capital expenditures, and is meant to show that CapEx spending tends to lag earnings growth by about 4 quarters. On the right-hand side of the page, we show that companies have had a preference for returning cash to shareholders through buybacks. In other words, they buy back their own stock on the market, and dividends, while capital expenditures have seen a declining trend. We actually think that could change given the fact that the new corporate tax laws make capital expenditures more tax favorable, so we think that could increase corporate capital expenditures for equipment, machinery, that kind of thing. We could see an uptrend in that. The next chart on page 10 here, slide 10, shows the S&P sectors ranked by their volatility to the index. So the slide shows sector weightings for the S&P 500, the Russell 1000 value, and the Russell 2000 growth index, returns by sector for various time periods, and various valuation metrics, including forward price to earnings ratio and dividend yields. All of this information can help investors help us determine whether a sector is attractively valued and set expectations for how it might behave going forward. A lot of data here, a lot of numbers. Just what I'll comment on is that not everything performs equally in market cycles. So right now, certain areas have done very well, and other areas haven't done as well. Like energy through 2017 was actually down 1%, energy stocks. Telecom stocks were down 1%, whereas the financials were up 22, materials up 23, consumer discretionary 23, and technology up 38. So it definitely was a market where it favored growth stocks over valued stocks. This next chart, number 12 here, is one of our favorite charts because it shows the intra-year stock market declines, which are the red dots in numbers, as well as the market's return for the full year, which is the gray bar. What's clear is that market is capable of recovering from intra-year drops and finishing the year in positive territory, which should encourage investors to stay the course when markets get choppy. Again, almost every year, I think with one or two exceptions, the market was down during the year, at least some percent, and yet in about 70% of the years, the market at the end of the year finished up positive. Some of the swings were significant swings. 1998 was down about 19% at the beginning, or at some point during the year, and then it finished up 27%. Again, it's about a 50% swing intra-year. So you can see definitely the market just because it's down doesn't mean the day's over or the game's over. And that we saw that again this year already in the last couple of weeks when we had, after a strong January, February started off with a big decline of about 10%, and yet the market again kind of rebounded and now shows slightly positive for the year in spite of all the volatility. The next chart again is one that we really like on page 16 of the guide because it shows on a logarithmic scale since 1900 the market cycles, and it illustrates the long-term trends of the market. And we see this over and over, but the market tends to move in what we call ranges or trend-bound market cycles. And so when you draw a line connecting point to point, what we basically see is in 1900, for about the next 25 years, the market was pretty flat, a little bit of up and down, but pretty much side to side. Then the Roaring 20s brought a big run up in the market, and then the Great Depression, starting in 1929 actually, and a big decline. Again, we've all pretty much heard about it, what a terrible time it was. Then the recovery from 33 to 40, and then a flat period of almost 6 or 7 years. I'm sorry, more than that, about 20 years, flat. And then a run up from 1950, the end of the Korean War, to late 1960s, about a 20-year bull market. And then again, a sideways market during the Vietnam War and stagflation that lasted about 10 or 12 years. And then another bull run, what we call the Reagan era, about a 20-year market run-up from late 70s to late 90s. And then since 2000 to 2011, basically, as we know, the market bottoming in 2009, the market really went pretty much sideways. So the question we always ask ourselves, and I'm sure you probably are too, is this breakout that we see coming about 2012, when the market finally recovered what it had lost, is that a sign that we're going to see a long trend up, or are we going to continue to show this kind of volatility and fluctuation? So we don't know, obviously, but we certainly want to be prepared for the best, but also plan for the worst. The next chart here on slide number 19 looks at the current state of consumer finances, and the chart on the left shows the makeup of household balance sheet, and the top right chart shows what percentage of disposable income is spent on debt service, highlighting the consumer deleveraging we've observed over the past few years. The chart on the bottom right looks at household net worth, which is the sum of all assets, including home equity, less all liabilities. So kind of summarizing here, the chart on the left shows that as a nation we have about $112 trillion of total assets, and we've got about $15 trillion of debt that individuals carry. So from a total balance sheet perspective, we're just a little bit short of $100 trillion of net worth as a nation. So in many respects, analysts would look at that and say it's not a horrible balance sheet if, for example, if you or I had $1 million of assets, or $1,012, $1.12 million of assets, and we had $150,000 of debt, we'd probably feel like those ratios were okay and pretty good alignment. Other people look at the debt that consumers have and say it's a real problem, and it could lead to disaster. So there's all kinds of opinions on that. On the right-hand top chart, it shows the cost to service the debt. Now, don't let this misinform us. It doesn't mean there's less consumer debt. It just means that because interest rates have come down so much, that while there is increasing debt has moderated, the cost of debt has definitely come down, which makes the cost to service the debt or payments on the debt more affordable. And again, the bottom right-hand chart shows that household net worth has increased pretty significantly from the last peak of about $67,000 per household. Today, it's about $100,000 per household. So, yeah, roughly a 30% increase in the average household net worth. The next page 21, the chart on page 21 shows residential real estate and what's going on in some of these areas. The U.S. real estate market. The top left side of the page shows that mortgage rates are more affordable than ever. Housing affordability, shown in the top right, also is near historic lows, largely due to these low mortgage rates. On the other hand, as home prices have risen, households are spending a higher multiple of their income on home purchases. So that's a kind of competing statistics there. The bottom right chart shows the average FICO score on new approved mortgage loans, and which is relatively high compared to the historical averages, limiting access. So I think we've known this and have heard this, that it's harder to get a loan today. The average score is increasing, and banks are much more reticent to loan money out to those people with lower scores. Although interestingly, I've been hearing on the radio quite a bit lately these, and maybe television, these ads for a local consumer credit union that zero down mortgages. So, boy, that scares me a lot, because that's one of the things that got us in such big trouble in the 2007 debacle, was all these, they call them ninja loans, no income, no assets, no job. So these ninja loans really were a big part of the problem that caused the collapse in the economy. So again, something we want to keep an eye on. If we see too much of that, we would probably want to respond to that in a wise way, and look for some kind of a market reaction to that. If we get too much of that easy money, low cost money, people tend to overspend. The next chart on page 23 shows us federal finances, similar to personal finances, although the federal government really doesn't have the income to spending ratio that consumers have, but they certainly borrow a significant part of their cost to operate. And so projected for last year, about a $700 billion deficit, which continues to show up in increasing federal deficits. And so that is a concern of ours. We ended the year, as you can see on the right-hand bottom chart, with our debt as a nation about 76% of our total assets. So, I'm sorry, of our GDP, not assets, our GDP. So again, something we need to keep an eye on is, where does that ratio go? Over the next 10 years, that's projected to go up to 91%. So roughly 100% of the GDP would equate to our total national debt as a nation. And again, at some point, many people feel like, and we tend to share some of their concern, that this issue of debt is going to cause us some significant financial problems. So something we need to be aware of and have built into our plan that we have with you. The next chart on page 24 shows unemployment and wages. As you can see here, the unemployment rate and wage growth for production and non-supervisory workers since 1960. The two measures have had a historically inverse relationship. So as unemployment rate continues its descent from a high of 10%, we expect wage growth to pick up. So unemployment going down and wages going up. We haven't seen a lot of wage growth, but we're just starting to see early signs that wages are pushing up, and we just think that has to happen. We keep hearing from so many employers that we work with that they can't hire good quality people. There's nobody out there to hire, and so how do you attract more employees? You pay more, you offer more, and so we think that's going to be a natural outcome of what the cycle that we're in right now, and that could cause inflation. So we'll have to keep an eye on that as well. Next chart here on page 32 looks at the Federal Reserve balance sheet, and it shows the historical and projected balance sheet of the Federal Reserve. The chart is annotated to show how the balance sheet has evolved over time, including the beginning and ending of 3 quantitative easing projects, all identified in the chart. The forecasted reduction is based on Fed commentary and should help to guide investors toward what the balance sheet may look like in the future. Just as raising the federal funds rate impacts the short end of the yield curve, reducing the balance sheet impacts the long end of the yield curve. So we could see as the balance sheet reduces, which means they're basically pulling liquidity out of the marketplace, and they're reducing the available funds in the marketplace, and that should cause long-term rates to rise, just like as I indicated earlier, that the balance sheet itself could cause short-term interest rates to rise. Next slide on slide number 60 shows the historical performance and volatility of different asset classes, as well as an annually rebalanced asset allocation portfolio. The asset allocation portfolio incorporates the various asset classes shown in the chart and highlights that balance and diversification can help reduce volatility and enhance returns. The next slide on page 61 shows mutual fund and ETF flows over time. The bottom left chart shows ETF and mutual fund flows into bond, stock, and multi-asset funds, and the bottom right chart shows the quarterly flows into U.S. equity ETF and mutual funds with the S&P index performance overlaid on top of that, showing that for much of the time investors have missed the upward market moves by pulling out of the market too soon, timing the market. And slide number 68 shows the importance of staying invested and limiting losses. Illustrates 2 points. First, it is important to both stay invested and allocate to equities if investors are looking for meaningful returns over the long run. And second, that it is important to limit downside and protect against loss in portfolios, since large losses require even greater or larger gains to make the whole perform. So on the right-hand side, for example, if the market drops 5%, you have to make 5% to recover. But if it drops 20%, you got to make 25% to get back because you got a smaller base. If it drops 30, you got to make 43. If it drops 50, you got to make 100% to return back to where you were. So volatility is an important factor in portfolio management, and one that we certainly spend a lot of time addressing with our clients' assets and our portfolios. All right, well, that's the end of the content for today. Hopefully this has been helpful. Thank you for taking the time to listen and participate. If you have any questions, please feel free to give us a call, and we'd love to have a deeper conversation with you on any of this. Thank you so much, and blessings for your 2018.